All right, thanks everybody. As mentioned, my name is Ian Gendler. I'm the Director of Research at ValueLine. And let me just do about 3 seconds of housework okay. Today, using ValueLine's digital platform and investor tools, I'm going to show you how to quickly and easily find worthwhile investment candidates. Going further, I'm going to recommend one stock to buy right now. If you have questions, please type them into the chat box and I will get to them at the end. To start, for those joining us for the first time, I want to provide a brief overview of who we are at ValueLine. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the ValueLine Investment Service. The service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by ValueLine's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, ValueLine has no investment banking business with any company, including the 1,700 that are included in this service. ValueLine does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. As part of the formal presentation, let's start with an overview of the economic situation, as well as the ValueLine Research Department's view of the stock market. Obviously, this will help us with our search for a stock to buy right now. The following content was prepared by Harvey Katz, ValueLine's chief economist. The employment outlook is improving, with data issued at the top of December showing another strong monthly jobs increase. In all, the nation added 228,000 positions last month, which suggested that much of the nation had recovered from the devastating effects of last summer's hurricanes. Also of note, wages were up modestly, and the jobless rate remained at a 17-year low. The rest of the picture is brightening as well, with reports showing that manufacturing and non-manufacturing are holding up nicely, as are consumer confidence, machine tool orders, and new home purchase mortgage applications. In all, this 3-month span is likely to mark the third quarter in a row in which GDP rises by 3% or more. So it is not surprising that the Federal Reserve is moving to normalize interest rates. To wit, the bank took another step in that direction when it raised borrowing costs once again. The increase of 1/4 percentage point in the federal funds rate, which had been widely telegraphed by the transparent Fed, could be followed by 2 or more such adjustments in 2018. Meanwhile, the tidings from Capitol Hill are still in the news. Here, it appears like an approved tax reform bill will be presented to President Trump for his signature within the next several days. This new legislation, along with attempts to secure a long-term budget agreement, will likely have a meaningful effect on the stock market as the clock ticks down to 2018. For now, the bulls maintain the high ground, as most groups are holding their own or advancing further. Meantime, the major indexes secure one all-time high after another. In conclusion, it certainly has been a strong year for equities, and with the news still good, there may be room for more gains into 2018. However, the continuingly high PE multiples suggest there will be bumps in the road, at least from time to time. Now that we have a firm base in regard to the economy, stock market, and our outlook, it is time to find a stock to buy right now. As you can see, I am currently at our homepage, valueline.com. On this page, you can access, free of charge, daily market commentaries, as well as general interest articles that are written by our analysts. Examples of such content are analysis of economic releases and quarterly earnings supplementary reports on the 30 components of the Dow Jones Industrial Average. I'm now going to sign in with my username and password. After entering my credentials, I am taken to the welcome screen. From here, I can quickly get to many important areas of our website, including Browse Research, which is the main home for our core equities products. I can also head to our investor tools, as well as the home pages for our monthly stock selection services. For this presentation, I want to start at the dashboard, which is the main landing page for subscribers. As Harvey Katz mentioned in the conclusion of his market commentary, it certainly has been a strong year for equities. And with the news still good, there may be room for more gains into 2018. However, the continuing high PE multiples suggest there will be bumps in the road, at least from time to time. Before we go any further, I want to quickly expand on the first part of that statement. Indeed, it has been a strong year for equities. With just a few trading days left in 2017, the Dow and S&P 500 index have advanced roughly 25% and 20% respectively. Looking back further, it is important to consider just how far we have come from the depths of the 2007 to 2009 financial crisis. At the market low in March 2009, the Dow bottomed out around 6,300. Now we're knocking on the door of 25,000. Let's move to how the 1,700 stocks in the Value Line Investment Survey are being valued at this time. To do this, the weekly summary and index is a good place to start. This is a 40-page PDF that's updated weekly. As you can see on the left in the middle of the page, the median stock in our universe is trading at more than 20 times our 12-month share earnings estimate to June 2018. This is a good time to mention that Value Line's estimates are created completely in-house by our research team. Our PE calculation is also different from many other research houses. More specifically, we use a combination of reported figures and estimates for our PEs, which we think is better than using a trailing figure or just estimates. A PE above 20 on a historic basis is quite high, but is consistent with levels reached during other multi-year bull markets. Nonetheless, at these levels, there are surely a great number of overvalued stocks, or put another way, equities that are trading at unsustainable multiples. In addition, as mentioned, high PEs may lead to bumps in the road, so I'm definitely going to consider this metric when looking for the one stock to buy right now. Let's also take note of the median dividend yield of 1.9%. If stocks are indeed pricey, then price appreciation potential may be harder to come by. Thus, dividends may well prove useful in order to help fuel total returns. 1.9% is not exactly exciting, so I'm going to use a higher level for my search. Let's now go to the screener and find some candidates. This important tool can be found under the Find Ideas tab. Subscribers have access to more than a dozen preset screens, as well as 40 fields. I should also note that the screener possesses more than 200 fields in total, but those are only available with a higher level subscription. I'm now going to run a screen. Since we discussed it earlier, and it's important, let's start with price to earnings. As you can see, you just click on the field and it comes up. And you can enter the data in a couple of ways. I can use the sliding action bar to set my range, or just type the values in the from and to boxes. As mentioned, the median is 20.3, so I'm going to focus on stocks that are trading below that level. So I type 20.3 into the to box. I also want to remove stocks that are trading at very low multiples, which often implies that something, besides earnings, is impacting the stock. That can be a legal matter, recent management turmoil, or signify an industry that is currently out of favor. Thus, I'm going to set the low bound to 5. This will also remove unprofitable companies. Let's now add dividend yield. For this, I'm going to set the low bound to 2.5, which I think is a popular cutoff for income investors in this market. Next, with the market at such lofty levels, and we want to avoid those inevitable bumps in the road, I want to include a field that will provide some defensive properties. There are numerous risk and volatility measures, with beta probably being the most popular. However, I'm going to utilize Value Line's proprietary safety ranks. The safety rank measures the total risk of a stock and is arranged on an easy-to-understand 1 to 5 scale, with 1 being the most stable issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. For this, let's focus on stocks that have risk profiles that are better than average. For that, I select the 1 and the 2. Only the largest, most financially strong companies earn top marks for safety. All right, we now have a list of 80 stocks, and they are reasonably priced according to their earnings, offer a significant yield, and are relatively safe. That is all well and good, but I also want to include a growth-oriented field in an attempt to find holdings that will hopefully appreciate in value and hold good near and long-term prospects. The projected 3 to 5 year EPS growth rate will work well for this. And I also want to highlight that Value Line is one of the very few research houses that provide financial projections that far out. We think that these estimates are of great value to our subscribers since they show a long-term trajectory of the company. A lot of times, a company will introduce a hit product, but it may be short-lived. These projections will show whether a business has long-term staying power or if it is just a passing fad. So for this field, let's set the low end at 12%, which is a healthy level of average annual growth, particularly since we were already focused on relatively safe companies that offer sizable dividend yields. And there we go, 6 candidates. According to our criteria, these should suit an equity portfolio that wants to focus on reasonably priced stocks that offer meaningful dividends, above average levels of safety, and ample growth prospects. Before I move on, please note that users can save screens and revisit them later by utilizing the button at the top. If you're like me, you tend to watch a batch of stocks for a few days or weeks before seriously considering taking a position. Value Line's watch list tool makes this easy. I can access watch list from the menu above or from Browse Research, which I'm going to do now. To save time, I've already created the watch list for these stocks, but the process is quick and easy. I want to briefly mention a new website enhancement that we recently rolled out. As you can see in the watch list, we now provide quick access to our classic PDF reports. These links are now available on all lists, including the VLIS current issue, Dow 30, analyst covered stocks, etc. While putting together this presentation, I looked carefully at these six stocks and spoke in depth with the covering analysts and our industry experts. Of the 6, I am recommending a closer look at Toyota Motor Corp, ticker TM. Let's see why. Clicking on the company name will take us to the equity's digital report, where the data, information, and analysis is arranged in more than 15 modules or boxes. These modules can be moved around, resized, and hidden so you can create your own customized stock report. For instance, let's say I'm most interested in the analyst commentary. I can simply click in the heading and drag that module to the top. In addition, now I want to see more ranks-related information. Simply click on the larger rectangle. Once I alter the presentation to my liking, I can save the changes from the sliding horizontal action bar. The next time I come to the stock report, it will look the way I set it up. Let's first get some quick information about Toyota's business. I am sure you all know Toyota is an automotive powerhouse that can trace roots back to 1933. In our business blurb, you'll also see that it has more than 371,000 employees and is based in Japan. Importantly, I will cover this more depth in a minute, but Toyota trades here as ADRs, or American Depository Receipts. In this case, each ADR equals 2 common shares. How has Toyota stock been doing of late? From the valuation module, I can quickly pull up a stock chart. And the yellow line is the equity's performance. As you can see, it has been a bit of an up and down few years, though the issue has done well during the second half of this year. I'm now going to take a look at the analyst commentary to get some information in regard to what is going on at Toyota. Analyst Christopher Joseph stated the following in his most recent report. Favorable currency exchange helped drive Toyota's September quarter earnings higher despite roughly flat volumes. Vehicle sales of 2.18 million units were off less than 1% year over year, but in yen, sales climbed 10% as a result of the stronger dollar and euro. Unit sales were off 4% in Japan, reflecting a tough comparison with last year's second quarter as earthquake recovery prompted a sales surge. Cost reduction efforts helped spark a 65% increase in operating income in Japan despite the sales decline. In all, Toyota reported earnings per ADR of $2.72, ahead of last year's $2.51 and our $2.20 estimate. I now want to show you the classic PDF, which is included in a digital subscription, and provide some more analysis on why we think Toyota will perform well and the stock will trade for between 160 and 215 by the 2020-2022 timeframe. Accessing the PDF can be completed via the gray bar. Going back to the commentary, management boosted guidance for fiscal year 2017, mostly on a weaker outlook for the yen. The car maker added $1.8 billion to its net income forecast to $17.3 billion as a result of more favorable currency rates in the US and Europe. Moreover, Toyota now expects nearly $200 billion in added cost savings benefits. The company also nudged its forecast for total unit sales up 0.5% to 8.95 million vehicles, about flat year over year. The new Camry was introduced in North America this summer, which should help support unit sales in what has been a difficult market overall for automakers, especially in the US. However, despite the new model, the company expects a 1.5% drop in volumes in North America this year, primarily on weaker Corolla and Prius sales. Reflecting management's revised outlook, we raised our 2017 earnings estimate from $10.35 to $10.80 per ADR. We also revised our 2018 estimate upward 15 cents to $11.20. As for the stock, given the earnings gains we forecast out to 2020-2022, price appreciation potential over that period is compelling. Income investors may be attracted by Toyota's yield of around 3%, which is well above the average yield in our universe. Let me now expand on Toyota's ADRs. Interested investors need to be aware that Toyota pays dividends just twice per year, and U.S. residents have to pay a 15% Japanese tax. All told, after weighing all of the pros and cons, we think that Toyota, ticker TM, is one stock to buy right now. I hope you found the method for finding a stock to buy right now interesting, informative, and efficient. That said, I know this process does take time. That is why I want to highlight the fact that Value Line offers a variety of model portfolios that can help alleviate the work of finding worthwhile investment candidates altogether. Part of the Value Line Investment Survey is the weekly Selection and Opinion newsletter. Along with economic and stock market commentary and data are 4 model portfolios. You can access this also from the dashboard in the quick links, which I'm going to do right now. Selection and Opinion. And here are the model portfolios. Each one has a different investment strategy, is actively managed, updated each week, and always contains 20 stocks. The portfolios are overseen by senior research analysts. Portfolio 1 is best suited for aggressive investors and focuses on stocks that are expected to outperform the broader market over the year ahead. Portfolio 2 should be of interest to more conservative investors and focuses on dividend-paying stocks that also offer worthwhile appreciation potential. Portfolio 3 chooses equities with long-term price growth potential and, of course, is best suited for patient investors. Portfolio 4 is filled with stocks that possess above-average dividend yields and is for investors seeking current income. We have a great number of subscribers that follow these portfolios. For those interested in potentially adopting one of these strategies, here are a few helpful details. New positions always amount to 5% of the market value of the respective portfolio at the time of the trade. Any dividends received are simply taken as cash. They are not reinvested. Lastly, the portfolios are not rebalanced. All told, the model portfolios represent some of the Value Line Research Department's best investing ideas, and we recommend that you read the analyst-created content and look over the portfolios per possible additions to your holdings. Subscribers looking for a total investing solution are also encouraged to check out our premium monthly selection services, Value Line Select, Dividend Income Growth, Special Situations, and Select ETFs. If this is something that sounds up your alley, call 1-800-VALUE LINE for a free sample report. That marks the end of the formal presentation, and I will now tackle your questions. So give me 1 sec just to pull these up. I'm just going to do them in order that they came in. Okay, first question was, is there a replay? Yes, within the next 24 to 48 hours, this webinar will be posted on our website as well as our YouTube channel. Okay, actually, this is a question about one of the model portfolios. On portfolio 1, why are several stocks ranked 1, but I'm sorry, I just lost it. Stocks ranked 1, however, the PEs are above average. All right, well, let's take a look at portfolio 1. Make it a little bigger so everybody can see. As you can see, a lot of the stocks are ranked 1 for timeliness. I guess now is a good time for me to go into what that means. For those of you that don't know, Value Line has been ranking stocks for timeliness since the mid-60s. As I mentioned in the presentation with the safety, it's also on a 1 to 5 scale, 1 being best, 5 being worst. To be a candidate for portfolio 1, you have to be ranked 1 or 2, as you can see in the quick description here at the bottom. When the rank falls to 3, it automatically triggers a sell. So stocks that are timely, the system looks at all kinds of metrics, price action, earnings results, earnings surprise, cash flows, etc. And it does look at the relation of price to earnings, but it's looking for stocks that will outperform over the next 6 to 12 months. And as you can see from the PEs, some are fairly low, and obviously some are quite elevated. You got what I guess a few in the mid-high 20s, even one above 30. So PE is a qualification, but we're looking for stocks that are going to outperform over the 6 to 12 months. So a high PE stock, especially for momentum, may continue to head higher. All right, next question. What does the TTL mean above the 3 to 5 year growth projection? TTL stands for trailing 12 months. Oh wait, I'm sorry. Let me go to the screener. It just means total. Excuse me. I was looking at TTM. It's just abbreviating so we can fit it in the box. So it's total return. Next question, is the screener that you use available to Value Line 600 subscribers? Yes, if you have a digital subscription. Print subscribers to the 600 do not have full online access. So if you have a digital subscription, it's actually called the Investor 600. Okay, it looks like we have one more question. Do we have historic performance for the 4 model portfolios? It's not something that we post regularly, but if you send me an email or send customer service an email, they will forward you the results. Just something with timing, and we've gotten a lot of differences of opinions of the performance. As I mentioned, we don't reinvest dividends, and the portfolio holdings are always 5%. So we have a lot of people that follow those portfolios, but they don't get the same performance because of those issues. But we will send it to you if you'd like. That seems to be all the end of the questions. Thank you so much for attending, and have a great holiday season and New Year.